Most people think superannuation covers all their insurances. What are they missing?
It's such a huge myth when people think about it. It's a great starting point. Like, don't get me wrong. Like, superannuation covers you for your life insurance and total and permanent disability in most cases, which most people are not even aware of. So it's a great starting point when you don't have a mortgage, when you don't have dependents, when you don't have major liabilities. But when you do, it's important to look into what you're covered for. And what I've found with most people is that they just assume that because the super has something, they don't know what, they're covered for it. So it's important to look into what you're covered for. As a bare minimum, it should cover you for the level of the debt or the liabilities that you have. Because again, you don't want something unexpected to happen. But if you think about the unexpected, what if something happens? What if you were to pass away? What if you were to fall sick and not be able to work? Like, do you have the level of cover that can make sure that your commitments can be taken care of? Do you have the confidence that your family will be able to live in this home comfortably and not have to worry about paying the debt for the next 20 years? Like, you have to think of that scenario, and that's where it's important to look into it and make sure it covers you for that. And secondly, the level of cover and the features and the benefits. Like, a lot of the times the cover that you have in super is called unitised cover, where the cover actually keeps reducing over the years. Like, it does not stay, so it's not in your hands. It's being controlled by someone else and not you. You would be better off having the control over your insurances rather than having the superannuation fund decide that it's probably time to reduce the cover. And by the time you're 60 or 65, you're down to zero. That's when you need the cover the most, and you'll realize that you're left with no cover. I recently had a client turn 66. He wasn't aware that he will not be covered beyond 65. And now he's gone out to get insurance, and it's so expensive. He's developed diabetes, unfortunately, so it's even harder to get cover. So it's important to get yourself the right cover at the right age that would take you in the long run.
What are some of the common diseases that lead to insurance being more expensive?
Diabetes is number one. And it's a common one. Like, a lot of people develop diabetes at different ages. It's also got to do with your family history, your personal, probably your eating habits and your lifestyle. And a diagnosis of diabetes increases the chances of you not getting the right insurance and increases the chances of you getting insurance with substandard terms. You may have to pay extra to get the same level of insurance, or you may be denied insurance as well. So there's diabetes. There's also, if any pre-existing conditions like cancer or heart attacks would diminish your chances of getting insurance. And I think even BMI. So if you are slightly overweight, or that will put you at a high risk, which again increases the chances of you getting insurance at substandard rates.
So what would you suggest to someone who potentially doesn't have any of these diseases at the moment, but perhaps they have family who has these diseases, and there could be a chances of it being passed down, and it could just be hereditary?
Right. If you're healthy, that's kind of the main criteria insurers look at, which puts you in the low risk category. They do look at your family history as well and the incidence of you getting it. But if it's just one of the two parents, or if it's just one of the multiple family members that you have who's got a disease, it'll put you at a very low risk of it. It'll probably not impact your insurance applications, and you will be likely to get an insurance cover, which will be standard and which will take you in the long run. So if you are healthy, it's probably the best time for you to look into and get yourself covered for the right level of insurance.
If I got insurance when I was healthy, and then later on perhaps I discovered that I did have one of these diseases, does that impact that existing insurance? Does that mean I'm no longer eligible, or does that still apply? Insurers
rely on something that's called honest disclosure. Like, we have to follow the duty of disclosure. So if you are aware of something when you're looking and applying for insurance, you have to disclose that. But if you are not aware of it, if it wasn't diagnosed until then, you will be okay, because you've still followed your duty of disclosure. You disclosed what you knew at that point in time. Yes. So you'd still be covered for it. But if you known about it but did not disclose it, that would void your insurance agreement.
Why is income protection insurance important for property investors who are looking to grow a big portfolio and therefore willing to take on large amounts of debt in order to do so?
Very interesting question, Aagam. Property investors who are actually investing and diversifying their asset portfolio by buying these multiple properties, they sometimes fail to realize that the ability to earn the income is their biggest asset. Like, they've got all these assets, but it's derived through their ability to earn their income. So that's the biggest asset. And income protection actually comes into the picture, which protects this asset. Like if they are the asset of being able to earn an income. So which means that if they're not able to earn an income, say, God forbid, they fall sick or they get diagnosed with a serious condition, or they could have met with an accident and have injured their body, and hence they may not be permanently disabled, but even temporarily they may not be able to work and earn an income. Income protection comes into the picture and ensures that they're able to receive that income, even for that temporary period of time. So be it 6 months, 12 months, they are still able to continue receiving an income and hence meet their financial commitments. Because a lot of times I've met people who did not have the right insurance in place and had to sell off properties in order to meet the commitments. Because having this huge portfolio is amazing, but consider the risk of it. You committed to paying a few $1,000s every month as having this risk on board. So you have to ensure that what if I'm not able to pay that? Are you ready to sell off your properties, or would you have something in place that takes care of these commitments and ensures that your properties and your portfolio continues to prosper, even if something was to not go your way?
I think this is especially important where perhaps there's a couple and one of them is the sole bread earner of that family. If something happens to that breadwinner of the family, who is perhaps earning majority of the income of the household, and they're not able to work, they really need to, and they have all this debt, they really need to have some protection to protect the other member so they are not left with a massive debt
100%.
in the case where that significant
100%.
income earner is not able to work.
Yes. No, 100%. It's a very valid point, because when you are either like the major breadwinner for the family or the sole breadwinner for the family, it's so important to be able to protect that asset and that income that you're earning, because the entire family, like your partner, your children, your properties and the portfolio that you're building, they rely on that one single source of income. And having something that to be able to protect that, that's amazing. That's where, and I believe a lot of people are even unaware about the fact that they can actually insure that part, like they're able to insure that income. So being able to do that, knowing about it and getting the right sort of policy in place to be able to make sure that it gets looked after, because it's also not just about getting insurance, it's about having something that's reliable. Like say, a lot of people also have this misconception that insurance never pays. Because that's not true. It's about getting the right product in place. And if you do, it always pays when the time comes. Like it's kind of a shield that's going to protect you from life's uncertainties.
Do you have an example or a story where this life insurance or income protection insurance really came in rescue in a dire situation?
The example that comes to mind is of this client who's actually a cosmetologist. We've insured her for all her personal insurances, including life, income protection, trauma, etc. She recently, unfortunately, developed a medical condition through which she was unable to work for a period of time, close to 7 to 8 months, because she was undergoing treatment and everything for that. And she was the cosmetologist running her own cosmetic surgery clinic, and she's self-employed. So a lot of what happens in her clinic relies on her, because if she's not able to service, the clinic doesn't function, they're not being able to serve, and even the people working at the clinic could not be paid. And of course, all the other properties and everything that rely on that income that she was generating, everything comes to a stop because she's not able to continue to work for 6 months. Unfortunately for her, for having diagnosed with that condition, but fortunately she had the right insurance in place. She got paid a lump sum at the time of when she got diagnosed with that condition, lump sum that covered her for an income for almost a year. Plus, she continued getting paid her monthly income until she was not able to work. So she was financially very well protected. Even though she wasn't working, she was able to meet the commitments, pay off all the liabilities and mortgages that she had, the other living expenses that she had to take care of, and the staff as well, and continue to focus on her recovery as well, because finances was not something that she had to worry about. And thankfully, she recovered, went back to work, and now is also probably running it at multiple capacity. So it was a great outcome for her.
Income in this case really protected her from almost getting bankrupt.
Exactly. Protected her from selling off her investments or even her company going south. And it just protected her family from a lot of other unexpected situations.
Let's say we have a family who has roughly household income of 200K and they're a couple with 2 kids.
Yeah.
How much would life insurance actually cost them per month?
So for that scenario, I'm kind of just guessing for someone with a household income of 200K could have a liability of close to $1 million or a little bit more, may look to insure themselves for close to 1.5 to 2 mil in life insurance, say, for example. They have a healthy lifestyle, they're healthy with a good BMI, and they're non-smokers, and they are professional white-collared workers. They could be spending anywhere between 60 to 80 bucks a month for that level of life insurance, which is surprisingly cheap.
Now, let's say you have a couple with a household income of maybe 500K.
Yeah.
They have maybe 2 kids, maybe a place where they're living and a couple investment properties. What are they looking to spend per month in life and income protection insurance?
Sure. Again, I'm just kind of working out what is the level of cover they may need, considering that they have multiple investment properties, they're earning close to $500,000 between themselves. They could be sitting at a liability portfolio of 1.5 to 2 mil, may want to get insured themselves for 2 to 2.5 mil, as an example. Again, considering that they are healthy, they are a good BMI, they're a non-smoker, and they're working in a professional white-collared office sort of an environment, consider anywhere between 100 to 120 a month for that level of life insurance. Again, this is a very estimated, rough sort of a number, but this still gives you a ballpark of what you would be looking at in terms of the cost.
Now, let's say you have a couple who's earning over $1 million a year in household income. Perhaps they're a couple, business owner, or in high-paying jobs, and they have 2 kids. They have a home that they live in, perhaps some other assets, shares, investment properties. How much are they looking to pay in life and income protection insurance per month?
Sure. I'll break it between life and income protection separately. For $1 million worth of income and multiple properties, you could say that they would want to insure themselves for at least close to 3 to 5 mil in life insurance, as an example, considering they're looking at between that, keeping everything else the same, being non-smokers, healthy, good BMI, and professionals. You would be looking at, say, if I'd pick 5 mil as an example for their life cover, look at anywhere close to $180 to $200 a month for that level of life insurance. Income protection would depend on what they're looking to insure themselves for. So it's a monthly benefit amount that it works out. So say if they're looking to insure themselves for 15 to 20,000 a month as income protection, and considering they'll wait 30 days for them to start receiving the money. The wait period is basically how soon the insurance company starts paying you the money and how long they pay you for. So say it's a 30-day wait, the insurance company could pay them for up to 5 years, as an example. They could be looking at a monthly cost of around $300 to $400 as an example for their income protection. Remember, it's a tax deductible expense. So you would be able to claim, they would be able to claim it on their tax return at the end of the year and get a deduction on it as well.
Let's say some people have a property in like a different entity. So it's not in their personal name, but I guess there's still a personal guarantor for the loan. Sure. So let's say they're buying in a trust or whatever. Yeah. How does that work is sort of going to be my question.
In terms of life insurance?
Yeah, could they be protected for that liability? Even obviously they're a personal guarantor, but the loan isn't in their name, it's in the entity's name. So
Sure. It comes down to the question if that asset is important for you to be protected. Say, God forbid, something happens to you. Is there someone else who would continue to pay for that liability? And if not, you still want that to continue to be paid or get paid off if something happens to you, because you need that asset to remain for your family. Yeah. You'd still want to insure yourselves for that asset so that, God forbid, something happens. If you were to pass away, your family receives that payment that they can use to pay off that property. So that way, that property remains secure and your family doesn't have to bear the burden of having to either pay off for the property, or the bank doesn't have to come behind and take the property away from them.
Is it life insurance or income insurance I should use for this?
Life insurance.
Does my life insurance cover me for properties held in a family trust?
Yeah, it would. So basically, your life insurance is going to ensure that your beneficiaries receive the money if something happens to you. Say, God forbid, if you were to pass away, your beneficiary, that could be your children or your partner or whoever you appoint them as to be, would receive that money that they can use to pay off for that property. So even if that property is not held in your name, but you still want to get that property paid off if something happens, you're enabling your family to receive that money. They can pay that property off if something was to happen. So they are not left behind with a mortgage to be paid off for the next few years, or the bank doesn't have to come behind and take that property away from that entity it's held under, and you are still giving them that money to be able to pay that and finish that mortgage off.
What are some of the misconceptions that people have about lender's mortgage insurance, also known as LMI?
Yes, it's a great question, because a lot of the times people confuse the lender's mortgage insurance as something that they are getting to insure themselves, that they feel that if they were not able to pay the mortgage off, the lender's mortgage insurance will pay that off and they'll still have the property to keep for themselves, which is not true at all. So it's basically an insurance to protect the bank. So if you were to default on that loan or whatever, that LMI comes in and makes sure that the bank keeps getting paid regardless. So it's kind of protecting the bank, but you got to think about yourself where life insurance comes into the picture. The life insurance, basically, if you were to pass away, or if you were to get diagnosed with any terminal illness or something like that, which could be unfortunate, but again, we are all meant to die one day, it will ensure that your family and your home remain protected, and they get the money to pay off that mortgage, which is different because the LMI is only protecting the bank. They've made it compulsory because they need that insurance and that protection for themselves. And they have not made life insurance compulsory because they don't care, but we do care that you are able to protect yourself and your family from any unexpected situation.